The biggest mistake in crypto is not simply buying the wrong coin. It is confusing a convincing story with a low-risk asset. A project can have talented developers, useful technology, major partnerships, and a passionate community. Its token can still collapse. That is because a narrative explains why something might matter. Risk tells you what must go right, what could go wrong, and how much optimism is already built into the price. Those are completely different questions. Crypto narratives are powerful because they simplify complicated ideas. Digital gold, the future of payments, a faster Ethereum, finance without banks, artificial intelligence on-chain, tokenized real-world assets. Each phrase creates a picture of the future that is easy to repeat. But a good narrative can hide a long chain of assumptions. The technology must work, users must arrive, the network must remain secure, the token must capture value. Insiders must not overwhelm the market with unlocked supply. And after all that, the price you pay must still leave room for reality to beat expectations. Investor.gov defines financial risk as uncertainty and the potential for financial loss. It also points out that different crypto assets can have very different designs, benefits, and risks. That sounds obvious, but online discussions often flatten everything into one question. Is this project good or bad? The better question is more specific. What exactly am I exposed to? Start with tokenomics. Imagine a project creates 1 billion tokens, but only 100 million are currently circulating. If each circulating token trades for $2, the market cap is $200 million. That number looks relatively small. Now multiply the same $2 price by the full 1 billion token supply. The fully diluted valuation, or FDV, is $2 billion. Market cap describes the value of the circulating supply at the current price. FDV estimates the value of the full supply at that same price. Neither number tells the whole story by itself. The gap between them tells you how much supply may still be waiting off stage. This is the low-float, high-FDV problem. A small amount of circulating supply can make a token appear scarce. If attention suddenly increases, buyers compete for that limited float and the price can rise quickly. But the higher price also increases the dollar value of tokens scheduled for future release. A CoinGecko study using data from May 2024 classified 21.3% of the top 300 non-stablecoin crypto assets as low float, meaning less than half of their supply was unlocked.
The exact percentage changes as markets evolve, but the mechanism does not. Future supply matters. Unlocks are not automatically bad. Teams, early investors, foundations, and community programs often receive tokens gradually, so they have incentives to keep building. The risk comes from the combination of size, timing, cost basis, and demand. Suppose early investors bought tokens for 10 cents, and the public market price is $2 when their allocation unlocks. They can sell far below the market price and still make a substantial gain. New demand must absorb that supply just to keep the price stable. This is why reading a token allocation chart is not enough. You need the release schedule. Are tokens unlocked gradually, or does a large cliff arrive on one date? Who receives them? What percentage of the circulating supply does the unlock represent? And does the token have real demand beyond speculation? If you enjoy practical explanations that separate crypto mechanics from crypto marketing, subscribe. We make the confusing parts visible without pretending every project is either revolutionary or worthless. Next comes liquidity, which is not the same as market cap. Imagine a token shows a market cap of $100 million. That does not mean $100 million is available to purchase everyone's tokens. Market cap is simply the latest price multiplied by circulating supply. The actual pool of buyers may be much smaller. Let's follow a beginner through a decentralized exchange trade. The user chooses a token, enters an amount, and approves the transaction. The wallet signs a message authorizing the swap. A smart contract then takes one asset from the user and sends back tokens from a liquidity pool. The trade changes the balance between the two assets in that pool, which changes the quoted price. If the pool is deep, a modest trade barely moves the price. If the pool is shallow, the same trade causes heavy slippage. A chart can show a high price while only a limited amount can actually be sold near that price. When many holders rush toward the exit, the quoted value and the obtainable value separate very quickly. Then there is the risk beneath the token itself. A token may run on a blockchain, but that does not mean it inherits perfect security merely by existing there. Ask who validates the chain, how concentrated the stake or computing power is, whether the software has multiple independent implementations, and what happens if the network stops finalizing transactions.
Some newer networks trade decentralization for speed or lower fees. That can be a rational engineering choice, but it is still a trade-off. If a small validator group, company, or multi-signature wallet can pause the system, upgrade key contracts, or move treasury funds, users are relying on people as well as code. Cross-chain bridges add another layer. Suppose a user wants to move a token from chain A to chain B. With a common lock and mint bridge, the wallet signs a transaction, sending the original tokens into a contract on chain A. Those tokens are locked. The bridge observes that event, confirms it according to its rules, and mints a wrapped representation on chain B. The original token did not literally travel between blockchains. It stayed locked on chain A. What appeared on chain B was a claim backed by the locked asset. Now, the important question becomes, who confirms that the deposit really happened? It might be a group of external validators, an oracle network, a multi-signature committee, or a verification system tied more directly to the connected chains. A bug in the contracts, stolen validator keys, or a false message can allow unbacked tokens to be minted or locked funds to be stolen. Ethereum's own educational documentation warns about smart contract risk, counterparty risk, wrapped asset risk, and the additional trust assumptions created by some bridge designs. A secure source chain does not automatically make every bridge connected to it secure. Stablecoins reveal another version of narrative versus risk. The narrative is simple. One token equals $1. But different stablecoins reach that goal in different ways. With a centralized, reserve-backed stablecoin, the token transfer is recorded on-chain, while much of the backing exists off-chain. The issuer may hold bank deposits, treasury securities, or other reserve assets through financial institutions and custodians. Users are therefore exposed to the blockchain, the smart contract, the issuer, the reserve structure, banking access, redemption rules, and regulation. For example, Circle describes USDC as backed by dollar-denominated reserve assets, but its terms also explain that direct redemption depends on account eligibility and compliance with those terms. This does not make the token useless. It means the word stable does not remove counterparty risk. The same principle applies to a genuinely useful network. Real technology does not guarantee a good trade at every price. Imagine a new chain processes transactions cheaply and attracts real developers. That is evidence of a functioning product. But if its token already carries a massive valuation, future success may be priced in. If network fees are tiny, token inflation is high, and users can use applications without holding much of the token, adoption may not create enough demand to offset new supply. This distinction matters. A blockchain can succeed as infrastructure while its token disappoints holders. A game can gain players while its reward token loses value. A protocol can generate activity while most of the economic benefit goes to users, validators, liquidity providers, or a company rather than the token itself. So, when you hear a powerful crypto story, separate it into layers. What problem does the product solve? Does the token need to exist for that product to work? What creates demand for the token? How much supply is circulating, and who controls the rest? When are major unlocks? Where does liquidity come from? What chain, bridge, oracle, issuer, custodian, or admin key could fail? Finally, what expectations are already embedded in the valuation? A narrative is not evidence that these risks are small. It is a hypothesis about the future. The goal is not to become cynical about every new idea. Crypto has produced real technical experiments, useful payment systems, programmable financial tools, and new forms of digital ownership. The goal is to stop treating technological possibility as proof of token value.
The strongest story can still depend on weak tokenomics, shallow liquidity, fragile bridges, concentrated control, or an unrealistic price. Once you learn to separate the product, the token, the infrastructure, and the valuation, crypto becomes much easier to analyze. Which risk should we break down next? Token unlocks, bridge security, stablecoin reserves, or something else? Leave your questions and topic suggestions in the comments.